One of the most important commitments an investor can make is to managing your emotions during volatile periods of the market. As we've all experienced, market volatility is a constant part of an investor's experience. Yet it's how you handle your emotions during those periods of time that defines your long-term outcome. You're now looking at a chart that illustrates a 46-year historical look back on just how volatile the markets have been. On a macro level, the gray bar illustrates where the S&P 500 ended up at the end of the year, what the total return was, and the corresponding red dot below that indicates the inter-year drawdown of that specific year. What I think you should find interesting in this chart is that 35 of the 46 years that were being shown, the market ended in positive territory even after suffering significant drawdowns. When the markets pull back, which they always do, you have three decisions. First decision, do nothing. That's a good decision. The second decision, add money to stocks. That turns out over the long term to generally be a great decision. And the third decision is to sell. That inevitably proves to be long-term a very poor decision for an investor. What you're now looking at is the impact of pulling money out of the market during various periods of time. This market shows a 20-year span starting with $10,000 in the S&P 500. If you never pull the money out, you can see the first column on the left shows you what your annualized and total return would be over 20 years. As you step down to the right, what you're seeing is the adverse impact of missing the 10 best market days over 20 years. This supports the financial rewards of those people who have stayed invested through an entire market cycle of 20 years. You missed the 50 best days, you've actually lost 5% of your money over 20 years. Stay invested, stay the course, manage your emotions.